Welcome to Bendigo Bank's market update for April, with our latest forecasts and views for the domestic economy and global markets. This month we'll have a look at the ongoing conflict in the Middle East and its implications for the outlook, the latest jobs, inflation and consumer sentiment data, and the build-up to the next RBA policy meeting in early May. The Middle East conflict is now in its sixth week, and while there are still hopes of some form of ceasefire, the crucial factor for markets remains the timing of when the Strait of Hormuz fully reopens. Until then, not only will oil prices remain elevated, but a range of other key industrial and commercial products will be impacted. And recent strikes on Qatar's LNG facilities mean supply of byproducts such as helium and fertilisers will be restricted even when shipping resumes. This all creates a range of domino implications that markets continue to grapple with. But for Australia, the impact on inflation is being seen via the cost of petrol and diesel, despite the government's announcement of the halving in the fuel excise and some state-based measures including free public transport. All energy crises come with the risk of stagflation, the unwelcome combination of inflation and a slowing economy bordering on recession. So this event carries the same risks depending on its duration. The RBA have already hiked rates twice this year, an extraordinary change from market expectations in August last year when rates were projected to fall below 3%, with the steady unwinding of these cuts matching global resilience to tariffs and local outperformance in our labour markets, and the strong rebound in business investment. But ultimately, this all led to higher inflation much sooner than we and the RBA had expected. Core inflation was still only 3.3% in February, and the March number, out later this month, will probably only be marginally higher than this. But the RBA will need to decide in early May if the oil crisis and related disruptions will see supply and demand dangerously out of kilter, or if they can look through some of the data and not risk pushing the economy into recession. A few reasons for a slower pace of hikes from here, in line with our view that the next rate hike can be in August rather than in May, include the uptick in unemployment to 4.3% in February, the sharp fall in job advertisements in March, and the latest consumer sentiment data. Consumer confidence fell in the weekly ANZ Roy Morgan survey to 58.8, its lowest level on record, as petrol prices rose sharply at the same time that the RBA delivered its second consecutive rate hike. So, while household spending held up reasonably in February, and spending on fuel will be much higher in March, there is an expectation that discretionary spending will fall in the second quarter. Financial markets remain on the back foot, with a risk-off tone seen in currency, bond and stock markets. But again, the hopes of de-escalation in the Middle East are avoiding any dislocation in markets. Most stock indices around the world, including our ASX 200, are down around 6 to 8% from their record highs just over a month ago. So while a pullback or even a short bear market has been widely expected given the size of the rally, its extent appears at the mercy of how quickly supply chains can normalise and how soon a meaningful ceasefire can occur. Until then, downgrades to global growth are likely to be seen, prior to returning to a world where technology investment, especially in AI, has been the main driver of optimism in growth, asset values and productivity. All of this makes for a fascinating but challenging environment for the federal budget, where fiscal policy will be in focus on May the 12th. And that's the market update from Bendigo Bank.